Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of FinTech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm talking with Adam Mustafa, President and CEO of Invictus Analytics. Adam catches me up on what's going on with the Federal Open Market Committee this year, including how President Donald Trump is disrupting the board's dynamics like an activist investor, and how that has played out in the two big meetings this fall. We chat about the rate announcements before shifting to arguably bigger news. The Fed will end quantitative tightening after December. Adam walks me through the mechanics of quantitative easing and tightening, some interesting items that happened at the end of October before we recorded, and finally, the uncertainty that the Fed's balance sheet could cause for bank liquidity and deposit competition going forward. Banks worldwide use Tactile's AI decision platform to power their credit, fraud, and compliance workflows, and adapt them in weeks, not months. Built for banking, Tactile's platform is transparent, audit-ready, and made to test and optimize decisions continuously. Learn more at tactile.com. Hi, Adam. Thanks so much for joining me today.
Hi, Kiah. My pleasure.
I'm so excited to have you because even though I'm a bank reporter, I'm not a Fed watcher, which is a different subset, a nerdier, one might say, type of bank reporter. And so I was hoping to pick your brain to learn a little bit more about what's going on with the Federal Open Market Committee and what rates are doing and what the Fed's doing. So my first question is for you. Tell me about yourself and Invictus Analytics.
Yeah, sure. I'll keep it short and sweet. So my name's Adam Mustafa. I'm co-founder, CEO of Invictus Analytics. We help community banks customize their capital. So when the regulators come into their banks and say, hey, we want you at 9%, the bank client could say, actually, we don't need to be at 9%. We could be at 8 or 7.5. And here's our analysis to back it up. And that can be really powerful for a bank because you're essentially dividing your capital properly from defense to offense. And if you could do that properly, it's like raising capital at a fraction of the cost. So,
interesting.
We're the only ones I know who do that. So, yep, that's who we are.
Okay, so tell me, briefly, how would you describe the Fed and the FOMC in 2025 so far?
Well, it hasn't been boring. We'll put it that way.
Oh, good.
Obviously, obviously there's a lot going on. And there's a lot of politics involved. People are discussing issues that haven't been brought up. God, I mean, you'd have to go back maybe 100 years to talk about issues like Fed independence, right? I mean, so it's definitely not boring. It's a little frightening on the one hand, a little refreshing on the other hand, and those two things are polar opposites, but we kind of need both of them. But the way I look at what's going on with the Fed right now is, Trump, his background's Wall Street. And I almost look like what he's trying to do is the equivalent of what an activist investor does with an underperforming stock. And he's doing that with the Fed. And one of the tactics activist investors like to use is they like to put a director on the board, right? To
I'm familiar with this playbook.
To influence. It's more than influence. It's to disrupt. And I believe, from my point of view, what he did with Moran, or I don't even know if I'm pronouncing his name correctly, Moran, he's like the director representing the activist investor. And he is there to disrupt. Let's make no mistake about it. And it's creating an interesting dynamic for the Fed. Obviously, there's pressure to cut rates. There's been pressure to cut rates really since the beginning of the year.
Right.
And there's a couple directors on the FOMC, Waller, Bowman, who are doves. They're leaning towards rate cuts, right? But Miran is there to be the aggressive dove. And it is making for theater.
Okay, so we had a couple of rate cuts, right?
Yeah, we did. Yeah.
Okay,
Had
we
a
had
couple
one
rate
in
cuts.
yeah.
I'm sorry, go ahead.
We had one in September, and then we had one in October. Let's talk about them. Big, little, important, not important. What kind of signals are you drawing from it?
Yeah, it's interesting. So, the rate cuts in a vacuum, okay, not that big of a deal. We've cut by 50 basis points totality this year. Now, if you tack that on to the 100 basis points of cuts that were done in September of last year, we're now down 150 basis points from peak levels. And that, in totality does have an impact. I think what's more interesting, as it usually is what's the direction? How many more rate cuts in the future are we going to get? What does it mean for the banking industry? Because, that's what I do for a living. I work with community banks. So I'm always thinking about what does this mean for my bank clients? And again, it really comes down to the direction of it. And I think the big issue is this. Here, let's cut to the chase. The bottom line is there's a lot of uncertainty around whether or not they're making the right decision. I mean, inflation, right? Inflation is not yet back to its 2% target. Yeah, at its peak, inflation was at 9%. Now it's down to about 3. One quarter might be 3.1. The next quarter it's 2.9. Then it's 3. 3 is not the target. It's 2, right? So we've been stuck at 3, and we're in this last mile from 3 to 2 has been very difficult. And now you have employment data is softening. They don't know if it's because of the demand side, right? Companies aren't hiring as much, or the supply side, right? We're losing supply of workers due to immigration policy or disconnect in skill sets, whatever the case may be. But there is the increasing risk that they are prioritizing the employment side of the equation too much and not prioritizing the inflation side of the equation enough. And that has risks if they cut too aggressively.
Yeah. So and to make that more clear, the risk would be that lower interest rates could contribute to inflation, which is what we saw in 2020 and 2021 and 2022, which is what led us to have an aggressive rate increase, right?
Exactly. That's right.
And you mentioned that there's a kind of an overarching concern about just, are they making the right choice? Not how much should they cut, but like, should they cut? Should they raise? Should they hold? And I think we can kind of see that with the dissents, right? Like for a while, everyone was all the governors were kind of in lockstep. Like these were no dissents. I don't know if it's like 9-0, but you know what I mean? And then now there's like, one person was like, Miran was like, cut more. And one guy was like, cut not at all.
Right. Yeah. And the thing is this, and again, I watch the Fed enough, but I wouldn't consider myself a quote unquote Fed watcher. I'm not one of those people who's reading every line of every sentence of the speech to see, how many times did they use this word? And how many times do they use this word last time? And is that more or less, there's a whole cottage industry.
Like the transitory,
Exactly. Now, that being said, the one thing I do know is this, is that the voting that happens at the FOMC, it's not really an accident. Usually Powell knows before the meeting how everybody's going to vote, right? There's a lot of internal jockeying and politicking that happens before these meetings. These meetings end up just being a formalization of the votes that Powell already knows he has. And to your point, it is highly unusual to have very much dissension at all. Okay, it can happen, but to have dissension to this degree in both directions is highly unusual. And I'm pure speculation here, right? I don't have inside
Sure.
sources or anything like
Yeah.
that. But Miran, right? He's the activist on the board, right?
Right.
And he's off the reservation saying, "Hey, I want way more cuts. I'm not voting for this cut because I think we should cut even deeper." That's fairly extreme position, at least relative to the rest of the board. So it almost feels like, whether it was by design or subconsciousness, in a sense that the dissent the other way is sort of meant to, fight fire with fire a little bit and create a little bit of balance in the
Yeah.
discussion here, to give Powell some more protection. Because if there's so much pressure on Powell to cut, that may not necessarily be a good thing, especially given the risks we just described. And Powell could use help on the other side of the discussion.
Yeah, and it's interesting to be a bank reporter. I have asked myself over the years since I started my career in 2011, and interest rates were zero for like 6-7 years, and then slowly increased. I remember telling a friend, I think in like 2019, that like we would never have high interest rates again, which was like, don't ever listen to me because I got that one super wrong. And then to see rates spike and see them like decline, and to ask myself over and over, like, hey, are like low interest rates, are falling rates good for banks or bad for banks? Are rising rates good for banks or bad for banks? Because I started my career, every bank was like, well, we can't make any money because rates are zero. So we've got to make like 2 and 3% mortgages because rates are zero. And if rates were higher, that would be good for us. And then when rates spiked in 2023, it was bad, apparently, for banks. And so now it is interesting to see what's happening with banks as rates are lowering. And this other, probably more important thing that we're going to talk about, which is the end of quantitative easing. So can we talk a little about Powell's announcement that was also included with the rate decision in October?
Sure. Before we do that, let me add one piece of commentary to what you just said, because I am in total agreement. I remember working directly with banks in 2010, 11, 12, them complaining, rates are too low, our spreads are too low, we need rates to go back up. And then all of a sudden, 22, 23, 24, rates are too high, we need rates to go down. And, what I've learned through that process is, well, there's two things. One is, it's the speed at which rates change that sometimes throws off bankers. But here's the bigger thing, and not everybody will agree with me. I'm telling you from working directly with banks of all shapes and sizes, I just know this from my experience. Rate changes are often, especially on the way down, they help the weaker banks more than the stronger banks. Stronger banks, they're not going to benefit as much right now. Think of it this way. A simple example. Take a very strong bank right now who's got a lot of core deposits, low funding costs, and meanwhile, they have assets priced appropriately, loans, securities at close to market rates, and they have a really nice spread, right? Right now. If rates go down, their funding costs, they don't have as much room to go down, right? Because they're already relatively low. So those strong banks, they'll still have a great spread, but their spread, it won't be as great as it is now. And it's the weaker banks who are the ones who are very dependent on the more expensive, less core, less sticky source of funding that will benefit the most. So I think that gets lost sometimes. We easily group banks and we stick as one group. Actually, you've got to think about strong banks versus weak banks. But anyways, I just wanted to
it's interesting because you're saying strong and weak, but you're actually talking about kind of funding base and the costs that banks pay to borrow funds. And so the stronger banks have core funding that's stickier and tends to be cheaper or more controlled, and the weaker banks have more market-based funding. So they need the rates to be going down so they can kind of get cheaper funding.
For the most part, but we do need to consider the asset side of it too, the loans and the securities, right? So you could have some banks. There's a lot of small banks out there who have low funding costs, but they're not making any loans. Either they're too conservative, they're in low growth markets, and they're the same banks who bought 10-year treasuries at 1% back in 2021, right?
Oh,
Even though
yeah.
they have low funding costs. So, those banks, I wouldn't necessarily consider those the greatest banks in the world just
Strong.
because they have low
Yeah.
funding costs. And then you have banks, who are great asset producers. They make great loans at great spreads. They don't have a lot of core funding, so they're borrowing more at the margin, but at least they got the spread. So, we have to sort of look at both sides of the equation, but I do agree with you, generally speaking. Yeah, core deposits
Yeah.
is ultimately what defines franchise values for banks.
Okay, so what happened? What did Powell say on October 29th, and why do we have to talk about it?
Okay, so what Powell said is we are going to end QT, which is quantitative tightening. And I suspect you want to know what the heck that is and what does it mean, right? Okay,
Well, some of us are getting flashbacks from like 2015, right?
Yeah, oh yeah. I mean, this is their second time they've started and have ended what they call QT, or quantitative tightening. Now, let's take off the fancy lipstick that some PhD and some ivory tower came up with somewhere to brand these tactics. QE, QT. QE is quantitative easing. What does that mean? Again, it's just some way of labeling the Fed pumping liquidity into the economy. Okay. Now, here's how they do it. Let me give you an example transaction. Okay. This might hopefully make it easy. So, and let's go back to after the financial crisis. The Fed cuts rates all the way to zero to try to get the economy going, right? And to get banks lending. And when they cut rates all the way to zero, it wasn't making that much of a difference. It may have stopped the hemorrhaging, but didn't exactly
Yeah, it wasn't
ignite
stimulating
the
the growth. Yeah.
Right.
Yeah.
So meanwhile, you can imagine these discussions at the Fed. They're probably using fancier terms than I will right now, which is, what else can we do, right? What else can we do? We've already cut rates to zero. What else? What other tools do we have in the toolkit? Anybody got a toolkit? And this is where they said, okay, why don't we try injecting liquidity into the system by buying longer term securities? Well, let's buy 10-year treasuries as an example. And the way that works, the way that the liquidity is created, the Fed will literally create money on a computer. They will buy a treasury from a hedge fund through a bank. The hedge fund who owns the 10-year treasury has now just received cash from the Fed that did not exist in the economy before the Fed created this money out of thin air. And now that cash is parked at whatever bank, JP Morgan as an example, in a checking account. And it's now a deposit that exists, that didn't exist right before the transaction. And for JP Morgan, in my example, it's now the equivalent of money in the vault, but instead of it being at the vault, like it was 100 years ago, we have computers now. We're going to park it at the Federal Reserve, and which they call reserves at the Fed, and the Fed will actually pay interest, like it's a bank, to JP Morgan for these quote unquote reserves. So if you think about that process, money was created out of thin air, injected to the economy by the Fed buying the security, and now the hedge fund has a new deposit, and JP Morgan, in my example, has a new deposit.
Sure.
And imagine 4 trillion of these transactions, or the 4 trillion worth being created, and we have an economy that's 30 trillion in size. That can have a decent impact. Now, the reversal is, or QT is the reversal of that. Okay.
Okay.
Now, QT, you would think, oh, does that mean that the Fed is selling this treasury to the market, getting money back, and then they're going to burn the money? Almost. Except the Fed hasn't gone as far to actually sell the treasury. Sure. That's a more aggressive form of quote unquote QT.
Yeah, that'd be like a giant whale coming in, just unloading Yeah, that would be
Right.
bad,
That
right?
that would disrupt markets like crazy. But imagine they bought a 10-year treasury in 2014, and now it's 9.5 years later, or 9.9 years
Mm-hmm.
later, that same 10-year treasury is about to mature, right?
Sure.
And the Fed has it. Now all of a sudden, when it matures, the government owes the owner of that security, which is the Fed money, right?
Yep.
So say the government pays the Fed that amount of the coupon on the treasury. The Fed takes that money and they burn it. They basically dispose of it. They don't go and buy another
Yeah.
treasury to replace it.
Right. They
Now,
call
through
that
that
would be,
process,
yeah, they would call that rolling over, right? Like where you would just take the proceeds of the old money and redeposit it. That's a rollover. And then they don't do that. This is a
exactly.
burn. Okay.
So QT, you just nailed it. QT is rolling over less. So they're still going to roll over, just not dollar for dollar. So, and they actually had a target for how much they would allow to not roll over. And three different times in the last 2 years, they cut that target because they were scared of the consequences of taking too much liquidity out of the system. And this is also why they've come out and said, we're going to stop doing this in December.
Okay. Yeah. So that's the announcement is, with all that background, the announcement is Powell said, we will stop rolling over in December.
Yeah. He didn't use the word burning for sure. I would, but yeah, he's basically saying, we're going to stop. We're going to, starting in December, we're now just going to roll over. We're not going to not roll over, if that makes sense.
In banking, conditions change fast. Credit teams need to adapt without sacrificing credit quality, compliance, or control. That's why banks choose Tactile's AI decision platform. It gives teams the power to design, test, and refine credit, fraud, and compliance workflows using AI quickly and securely. With seamless data integrations and built-in testing, every decision flow can be optimized in real time. With Tactile, AI isn't a black box. It's transparent, explainable, and regulator ready, so banks are always prepared for what's next. For more information, visit tactile.com. Okay, so how would you said the Fed's balance sheet is $4 trillion. How did it get this big? And is that too big?
Yeah. So I'll clean up a couple things. So actually the balance sheet right now is about $6.5 trillion.
Okay. Sorry.
And no, that's okay. That's my fault because I was using 4 trillion in my example because before the financial crisis of 2008, there wasn't really a balance sheet. It was a few $100 billion. There was no such thing as quantitative easing or quantitative tightening before 2008. So this wasn't even a topic. The first round of QE, quantitative easing, occurred after the financial crisis and basically took the Fed's balance sheet from well under $1 trillion to about $4.5 trillion at its peak in the mid 2010s.
Okay.
And then they tried to, I think you noted, then they tried quantitative tightening. Now, I don't know if you remember this. In 2013, there was something called the taper tantrum, where basically it was Bernanke at the time. So Bernanke went to, I think he went to Congress, and he was, you know how like Congress interrogates, the Fed chair every now and then. So it came up in there, and this whole thing about the balance sheet, and Bernanke's like, yeah, we're gonna start to taper it down, whatever. He underestimated the market's addiction to this quantitative easing, and right after that speech, the 10-year treasury, I think from 1% to 3% in like a matter of days or weeks or something. And then the Fed realized, we can't just we got to be really careful about this stuff, right? Then they tried QT again. This is 2015, like I was saying. They get to about the September of 2019. And do you remember when the repo markets had their little tantrum, their little crisis?
I kind of, it's funny because that's like the edge of banking. It's like big money center, big Wall Street banks. And it's fun, and I remember it, but then like 2020 happened and it was like, oh, that was a nothing. That was a nothing burger. You thought you'd be worried about this and you should have been worried about this. So yeah, tell us about the repo thing that happened.
Yeah. But you're right. The pandemic, everybody forgot about it after the pandemic, but this was a big deal before the pandemic. And it was a big deal because at that point in time, the Fed had been, quote unquote, quantitatively tightening for a few years now, 3-4 years at this point.
Yeah.
And but there was no end destination, like, oh, we want our balance sheet to get to this particular size. They never came out and said it. People like me would say, oh, it's probably got to be a percentage of GDP or something like that. But there was they didn't know where the destination was. And essentially what they realized was, we'll know when we have a problem. And the 2019 repo market disruption was the problem. And in a sense, the banks who have the reserves at the Fed, right? All these reserves, these quote unquote excess reserves, they weren't as in excess as you would think. On paper, sure, they had all this liquidity, but you got to remember these large banks, with all they have a lot more compliance pressure on them after 2008 and after Dodd-Frank than they ever had before.
Yep.
They have liquidity stress tests they got to be in compliance with. So they started to hoard their liquidity because as quantitative tightening was happening and was withdrawing this excess liquidity, it wasn't a problem because they didn't care. It truly was excess liquidity. But the moment that issue happened, they realized, oh, this isn't excess liquidity. We need to pause. Now, fast forward to today, they are scared. The Fed, they're scared of what happened in 2013. They're scared of what happened in 2019. They were able to contain those two issues, but it's the problem is that when these issues start to happen more frequently, the markets lose confidence in the Fed. So it's pretty serious when you think about it that way. And that's why they said, we're not going to wait for a third blow up to happen. We're going to stop doing it now.
Yeah. Yeah, that's really interesting. Okay, so it's the end of quantitative tightening, right?
Right.
Okay.
Yep. Tightening is the shrinking of the balance sheet.
Right.
Yeah.
And so what do you think is going to happen to the Fed's balance sheet? I finally pulled it up. There was the balance sheet at the Fed. It looks like it is $6 trillion. So is it just going to be at $6 trillion? It used to be $1 trillion in 2008. So.
I know. Exactly. Yeah. So.
That's crazy. This is a crazy chart.
Yeah. These are all to be determined questions. I'll give you my 2 cents, okay, for whatever it's worth. First of all, what's really interesting is about the timing that we're doing this podcast. It's November 4th. You want to know what happened on Friday, November 1st? Or, it was really October 31st on Friday, right? It was this past Friday.
Sure.
So my apologies.
Halloween, yep.
Last day of the month. And this is usually the last day of the month. There's some cleanup the banks do with their balance sheets. Also, there's people who are paying their taxes late. So there's a lot of money, planning happening. And two very interesting things happened, at least interesting to people like me, that happened regarding the Fed's balance sheet. The first thing is, after the 2019 repo blow up, a year or two later, this is, after the pandemic quieted down, the Fed quietly created a new facility. They called it and again, nerdy terms coming, standing repo facility. What the standing repo facility was designed to do is basically say, the Fed saying to these large banks who are lenders in the repo markets, like, hey, if you guys are concerned about not lending out your excess deposits, you can borrow from this facility we'll create for you, and then borrow from this facility, lend into the repo markets and make a little spread. So and it's designed to prevent the repo markets from getting
This sounds like a fake discount window. I love like the Fed when they make their like fake borrowing facilities and they just call it something else than a discount window. But yes, go on.
But you're so right. In fact, the borrowing rate at this standing repo facility is the exact same as at the discount window, which right now is 4%. Okay. So now why this is important is because if you start to see banks drawing on this facility, it's a sign of potential liquidity issues. I wouldn't call it a liquidity issue. It's more like imagine like your water pipes and all of a sudden, you get a little burst. You kind of patch it up a little bit. Maybe, your pipes will still work, but you got this little burst that happened, right? Mm-hmm. So this facility was created in 2021 and nobody drew on it for 4 years. The first time it got drawn was in June of this year, June 30th, for a very small amount. Off the top of my head, I want to say it was like $10 billion, so very small amount, paid back the next day. Sure. People were like, oh. On Friday, $50 billion was drawn from this.
Oh my God.
Right? So now it was paid. I forgot to check this morning with now. But $50 billion was drawn Friday. Now, which is a sign of liquidity shortage. But here's the kicker. There was another reverse facility the Fed had for the money market funds during QE called, and again, nerdy term coming, warning, the overnight reverse repo facility or purchase program, whatever they want to call it. And what this was it was the opposite. It was basically this filter, this bucket to catch excess liquidity coming into money market funds who, believe it or not, with all of our federal deficits, didn't have enough treasury bills to buy. So the Fed said, no problem, park your money here. We'll pay you the low end of the Fed funds range. And it was a way for the Fed to control the bottom end of the rates that they want, right? Because they don't want the rate. They got to control rates on both sides, not just rates going higher than they want, but rates going lower than they want. This was really more of a problem in 21, 22. And this facility at one point was $2.5 trillion. It hit pretty much zero in September. Okay. Now, on Friday, $50 billion came into it. So on one hand, I kid you not, I know this sounds crazy.
These two people got to talk to each other. You know what I mean? The Fed's being a middleman. These two banks, a hedge fund, whatever, they need to just find each other.
You got excess liquidity coming into one part of the Fed, and you have banks borrowing liquidity from the other part of the Fed in almost the same amount. So what all this means, I don't know, but what except that it's an indication of, hey, there's some potential issues we got to watch out. We cannot take liquidity for granted. So to come back to your question, right? What does this all mean going forward for the size of the Fed's balance sheet, right? It probably means, honestly, they're gonna by not, even if they just stop QT, if the economy gets bigger and the federal government debts get bigger and it needs more cash, QT by not doing anything, it's almost tightening because they're not growing the liquidity with the size of the economy and the size of the government's debt. So there is likely to be pressure for QE. Again, it might be a milder form of QE, or but it's a maze of it's like whack-a-mole. Right? We fix this here, and now we got this hiccup here. Boom,
It just feels like kind of like this weird three-body coordination problem that the Fed had stepped in, really in 2008 to provide this very specific type of liquidity backstop, creating money, the money creation. And I think it's really kind of important to tie back because you mentioned inflation earlier. The Fed was injecting all of this liquidity into the market, into the economy after 2008. And we had very little growth. And so we didn't have kind of some of this inflationary concern. And so I don't want to say it was like free for them to do this because obviously like the balance sheet expanded so much, but like there was like the economic consequences were not really experienced, or the economic impact wasn't really experienced, so much so that they had to do multiple rounds of QE. And I remember as a bank reporter at SNL and S&P, like I would have to write the market column on Thursdays, and when the Fed would the Wednesday, the meeting would end on a Wednesday. And then the next day I would have to write this market column. And stocks would always be up when the Fed was like, oh, the economy is so weak that we either have to continue doing QE, we're going to increase our purchases, like the purchase rate every month. And it was like, oh, and then I'd call people up and be like, hey, so why are stocks up? And they were like, oh, well, the Fed said they were going to do QE. And I was like, but isn't that because we have like so little growth that the Fed has to like step in? And I kind of learned like one of the big takeaways that I still even have today is like markets will move on news that is like kind of bad for everyone. If it's good for like, I don't know, stocks or whatever. And so I really kind of had to be like, not take market movement as seriously as maybe other signs. But now we live in just a different environment than 2010, 2012, 2014. And it is interesting to see the Fed as like almost more of a market player, where like we used to have broker dealers or investment banks doing this like, the like liquidity or the matching. And now it's the Fed, right?
Yeah, it's interesting. I mean, is bad news good news, or is bad news bad news?
I know. Are we back to that again? Because I can't. Bad news needs to be bad news. Good news needs to be good news.
I know. And it's what's interesting is the markets. I mean, the markets at all time. You know what's really interesting, and I'm not sure if I'm answering your question, but I'll just share with you what's
there wasn't a question in there.
Which is, right. You know what it is? It's like, if you think about where the stock market is right now. I mean, it's pretty much hitting all-time highs almost every day, right? It might have been down. Right. I don't even know what it's doing today, but like it's hitting all-time highs. Those are the risk-on assets, crypto. You know, I know Bitcoin's probably in the 110 range, and maybe it was at 120 or 125 in its peak, but it's a lot higher than it was 2, 3, 4 years ago, right?
Oh yeah.
So you have risk assets right now are at all-time highs. But you know what are also at all-time highs? Risk-off assets. Gold is what? $4,000 and you know, I mean, I remember it couldn't break through 2,000. Now it's at 4,000. Treasuries, right? Oh, nobody wants to buy U.S. Treasuries. Everybody hates the dollar. Well, the 10 years is closer to 4 now, when it was at 4.5, 4 months ago. So you still have it's almost like you have so much liquidity in the system, despite these issues with this facility and that alphabet soup facility at the Fed. So much liquidity in the system that risk on and risk off assets are at their like all-time highs. When does that make any sense?
Right? There's yield everywhere.
Right. It's kind of distorted. Yeah. It's interesting times. Yeah. And the one issue is whether the Fed's balance sheet is $6.5 trillion like it is today, or closer to 6, or it's $9 trillion like it was at its peak, or $4 trillion maybe like it was in 2015. The fact of the matter, it's something. It's something greater than 0, or greater than $1 trillion, and there's longer term consequences about the Fed having a balance sheet. One of them is that it blows asset bubbles, right? Quantitative easing, the Fed injecting this kind of liquidity in the market does blow asset bubbles, and the market gets hooked on these bubbles, right? And it's actually in many ways increasing more risk into the economy. And this is also why the housing market has completely been basically stopped, right? Interest rates have gone higher, but housing prices haven't come down, right? And housing prices have, for the last 15 years have, blown up in many ways. And a lot of that, not all of it, but a lot of it can be traced to the longer term implications of quantitative easing.
So you mentioned like the liquidity, excess liquidity. And and we're talking a little bit about, the Fed's balance sheet. Can they shrink it? Like, where should they shrink it to? What are the long-term implications of the shrinking? What should banks know if the Fed about what's going to happen post-December? And I guess I'm asking this in part because, outside of like quantitative easing and quantitative tightening, I remember there was like a period of time in 2022, like fall 2022, where it felt like in 1 month, in 30 days, we switched from banks have too much liquidity or too many excess deposits to banks do not have enough this was like 6 months before SVB was like, you might need to like lock up some liquidity or make sure it's priced or, every single bank customer is about to realize they can get a higher rate deposit somewhere else. And it just felt like liquidity was really shifting and people just had like different thoughts about how much liquidity they needed and how much, and like what was excess. So, what should banks do? Can they do anything? Do you think banks need to know what they need to do ahead of December, ahead of these actions that the Fed's taking?
Yeah, it's a great question. And whenever I'm talking to my bank clients about this, I'll often hear from directors, especially director at a bank in the Midwest, maybe $1 billion in assets, who's saying, repo markets, we don't do anything in the repo markets. Why does this matter to me? Why are you telling me about this, Adam? Right? And here's what my response to them is. It's like, it's because you have to think of what is going to be the impact on your ability to grow your deposit base or even preserve your deposit base. You think of deposits as a pie. Okay. Now there's different things that could increase the size of the pie or decrease the size of the pie. But QT, for sure, QT, quantitative tightening, which removes money from the banking system and essentially removes deposits from the banking system, is definitely not increasing the size of the pie. And you could argue it might have been shrinking the pie a little bit or offsetting anything else that was increasing the pie. My point is this: if you're a community bank or even a regional bank and you have to grow, right? You got to grow every year. You got to grow. I got to grow my loans. I want to grow my deposits, core deposits, right?
Yes, I'm familiar
with this. If you're going to grow if you're going to grow and you're not growing, if you need to grow your slice of the pie, or you need to grow your slice of the pie faster than the whole pie is growing, that's a different conversation than you growing your slice of the pie with the whole pie. And it means more competition for deposits, especially from the large banks who are on the front lines of QT and have a lot of competitive advantages over smaller banks in the war for deposits. So even though rates are going down and that helps banks on the marginal cost, it's sort of an offsetting factor in a sense that like, hey, it's, our ability to grow our deposits and grow non-interest bearing deposits is not going to be that easy. Even though the Fed stopped QT, it stopped maybe a lot of pressure on it, but it's still like to what we were saying before, even if the Fed's balance sheet stays where it is, if you have the federal government with trying to fund increased deficits, right? That money is going to come from somebody, and it's not coming from the Fed anymore because they're not doing QE at least, right?
Yeah.
It's not coming from China anymore. It's mostly going to come from domestic investors. And that means your deposits as a community bank are in many ways in competition with our own government. And you have to think about it that way.
Yeah. And I think there's, this conversation is really important because, there's just more moving parts. The Fed is a market player. The Fed is changing their actions as a market player. The direction of rates, the fact that there might be some like shrinking of the balance sheet or expansion of the balance sheet, or the balance sheet just doesn't have like a direction right now. And I think for community banks, they've got like, a lot of things on their plate. but they might be kind of tempted to look at the rate decision and are like, great, we'll just reprice our deposits. Everyone's getting paid a lot less, and we'll be good. And if you kind of take your foot off the gas as far as gathering deposits and growing relationships. And I think we didn't even talk about stablecoin, so I guess I lose that I'm bringing up stablecoin. But if you think that stablecoin is also going to, even if they work perfectly and they're super safe and everyone really wants one, they're going to take deposits out of your bank and put them into stablecoins that then are deposited as reserves. That still is again, competition for deposits. And, I just think that, the many community banks are going to have to reckon with that. There's just going to be way fewer non-interest bearing deposits, and that they will have to pay they'll have to pay something that keeps the relationship, or they'll have to be pricing their relationships correctly so that they can, they can bring in, attract the deposit and attract the rest of the business,
Totally agree. And look, at the end of the day, that's okay. As long as you are aware of that and are not just blindly setting goals based on strategies that might have worked in 10 years ago when we had quantitative easing happening and the Fed's balance sheet was getting bigger, or even strategies that were working 3-4 years ago. Those same strategies may not work now. And in fact, it's kind of funny, it felt like whatever, almost anything banks tried during quantitative easing worked to grow deposits, and everybody thought they were brilliant. Look at all these deposits I added, right? In fact,
easy.
Kiah, you said it before at the beginning of the call. I had a client once. I'll never forget this. This was back in 2011. So I was a young buck, I was starting a company.
It was a different world.
We had a bank client who called me and said, it was the last day of the quarter. He said, we just had a customer walk in trying to deposit $25 million into our bank.
Oh my God.
And we didn't want them to, because that was going to hurt our ratios. They didn't want all these excess deposits. They used to call them surge deposits, if you remember.
Right.
And they were trying to find ways to not have this customer make this deposit at their bank. And you fast forward to today.
It's a hot potato.
Most banks would kill for that. And we got to remember, franchise value is based off, in many ways, your core funding base. And just be realistic, especially if pairing how you are going to fund loan growth, right?
Right.
A lot of banks are going to get excited about potential loan growth. Don't get over your skis funding it with hot money. It's okay to use hot money, but too many banks out there are too dependent on the hot money and have too much of their balance sheet tied up in the hot money. On the way down, with rate cuts, it will mask those weaknesses to a certain extent. But at the end of the day, you got to think long game. You can't overreact to 1 or 2 rate cuts or rate hikes one way or the other, or even you can't even overreact to quantitative tightening. You have to have a disciplined approach and don't think of it as a land grab.
Well, Adam, I have a lot to think about. I guess we should probably get together after December, do a little check-in, see what the overnight reverse repo and the standing repo have been doing, and what size the Fed balance sheet is. But thank you today, so much today for joining me today. I really appreciate it.
It's my pleasure, Kiah. Thanks for having me, and I'm shocked you want me back, but I'll be happy to come back.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.